This week, the largest company in the world, Nvidia, ticker symbol NVDA, reports earnings, making it one of the biggest events of the earnings season. It could end up shifting the entire market this week and in the months to come. Now, why do I say that? With Nvidia being the largest company in the world, it makes up a large percentage of the major indexes, even if you don't own the individual stock. As an example, it's 7.23% of the S&P 500, the largest holding, and it's 12.5% of the NASDAQ 100, the largest holding. So this is an event that matters for the entire market, everyone invested in the US stock market, and especially for me. As many of you know, I have built up a large position in Nvidia over the last quarter. I detailed my full thesis in a video last week where I discussed why I think Nvidia will be the first $10 trillion company. For context, it's currently at a $5 trillion market cap. The growth of Nvidia's actual business has been historic over the past few years. They have beaten earnings every single quarter going back to early 2023. That's 14 straight EPS beats, and they have beat 19 of their last 20 revenue estimates. In the most recent quarter, they beat their earnings per share number by 6.3%. That quarter came in at $1.87, up 130% year over year. And in the past 5 years, their quarterly earnings per share is up 1,458%. That's an 84% compound annual growth rate. However, just because Nvidia keeps growing and beating their earnings, that does not mean that the stock always pops after reporting earnings. In fact, Nvidia has had 4 straight earnings beat and guidance raise quarters, and the stock price fell each time the following day. The most recent one, the stock fell 0.8%. The one prior, 3.2, 5.5, 1.8. Despite beating earnings per share expectations among analysts, raising guidance, and seeing historic earnings per share growth. In fact, Nvidia stock hasn't had a post-earnings pop in the stock price since May 2024. When Nvidia stock falls, the whole market, especially the NASDAQ 100, falls with it. And that's because Nvidia is the top AI semiconductor name, and it can move that entire trade, the entire supply chain. So is Nvidia going to go up or down after earnings? I think the answer to that question has to do more with market sentiment than the actual earnings results, because it seems fairly obvious they're going to beat and raise guidance again, especially since we've already gotten the earnings reports from all the big tech companies putting out the large CapEx spend in the data center build out. Alphabet is still increasing CapEx and raised their CapEx guidance. Microsoft is still raising CapEx and increasing their guidance. Amazon is still raising CapEx and increasing their guidance. SpaceX is increasing CapEx for their AI data centers and they're raising guidance. Same with Meta. But as Warren Buffett says, in the short run, the market is a voting machine. And the market has been voting in the past 4 quarters for Nvidia that they don't believe the growth will keep going. Nvidia's stock price is only up 15% over the past year, while its trailing 12 months earnings per share is up 64% in that time. They earned $48 billion of free cash flow in the latest quarter. The other part of that Warren Buffett quote is that in the long run, the market is a weighing machine. Over the long term, the market will weigh the intrinsic value of the company. So while Nvidia's stock price hasn't done much over the past year, it certainly is becoming a heavier and heavier business. The second most free cash flow generated in the entire stock market over the trailing 12 months, $119 billion, and the company is still growing quarter after quarter after quarter. Nvidia will soon be generating the most cash of any company ever. But that doesn't mean it's going to pop on this earnings report. In today's video, I'm going to give you my thoughts on this upcoming earnings week, the stocks I'll be watching, and that I'll likely cover in detailed follow-up videos. That includes an extended look at Nvidia and some beaten down software stocks that could be value plays, companies like Intuit and Salesforce, some dividend growth stocks that have been slowing down, and a semiconductor company that Nvidia's CEO said a few months ago could be the next $1 trillion semiconductor company. With that said, let's roll the intro and get into today's video. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using dividenddata.com, which is the best stock research tool. You can get an earnings calendar to keep track of the entire market, including stocks on your watch list and in your portfolio. You get 30 plus years of financial history and great tools to help you find the intrinsic value of a company and when it may be trading below fair value. So if you want to follow along with me throughout the video and use dividenddata.com for your research, right now we have a great deal where you can get 50% off annual membership. And if you're someone like me who's building an investment portfolio and it's a big part of your financial future, I think this is a no-brainer product. If the tool helps you find just one better investment or avoid a potential mistake, then it way more than pays for itself. The link is in the description and pinned comment in the video, or you can scan the QR code in the bottom right corner. All right, so here's all of the earnings this week. I filtered by just the US companies to help make sense of it above a $1 billion market cap. Tuesday before market open, we have Dick's Sporting Goods reports, which is a pretty interesting company. If you're a dividend investor, they have a 2.79% forward-looking dividend yield. The dividend's been growing at a 3-year compound annual growth rate of 7.72%. And it's actually had much higher dividend growth over the past 10 years, even with one large special dividend. Over the past 10 years, it's grown at a 23% compound annual growth rate, and they have been doing annual dividend increases. And if we look over the past 3 years, the stock price has gone down recently, so the dividend yield's a little bit higher. This 2.8% yield, it's in the 87th percentile over the past 3 years. However, there was a point where you could have gotten this at a 3.5 to 4% yield. I haven't been following Dick's that closely, so I'm not going to dive into the details right now. But one company I've done a few videos on that I think is a pretty interesting value play, whether you're a value investor, a growth investor, a dividend growth investor, and that's Intuit, ticker symbol INTU. If you've been following the market, you know software stocks have gotten beaten up over the past year and a half. Intuit's no different. They own QuickBooks, they own TurboTax, they own MailChimp, they own Credit Karma, pretty big software company in the US. And at one point, they were down 67% from their all-time high, and that was over the span of about a year. They've since rebounded a little bit, but it's still definitely in the value play territory, especially relative to how it's historically traded. And one of the themes when we discuss earnings reports and earnings season is it helps put the attention on the things that actually matter in the business in the long run, which is the actual earnings, the cash flow the company generates. Ultimately, that's what helps determine the actual intrinsic value of the company. It's the cash flows and earnings that allow a company to pay dividends, do share buybacks. But stock market price, it can be irrational in the short term. It's often based on emotions, it's based on feelings, and it's based on sentiment about the future, which may or may not be correct. Since AI coding agents came out, basically the thought has been that software companies are now less valuable. There's thoughts that there could be increased competition coming very quickly, and there's also a question about whether these companies can exist in the same exact business model they do today. So companies like Intuit and Salesforce, which I'll discuss later, these were viewed as premium companies. They traded at premium multiples because they're thought to be reliable subscription revenue that was going to be there in the long run, continue growing. And now some investors are questioning that, but that could be the opportunity for the long-term investor. Intuit's earnings per share over the trailing 12 months, it's at an all-time high, $23.04. It's up 18.4% year over year in the same time where the stock fell 67%. And you can see in the long run, Intuit has been a compounding machine of earnings growth. They generate a ton of free cash flow, $7.7 billion over the trailing 12 months. That's up 26% year over year. Over the past 10 years, a 26% compound annual growth rate of free cash flow. And this is why Intuit has become a dividend growth stock. The current forward-looking dividends, $4.80. Forward-looking dividend yield, 1.3%. Over the past 5 years, they've more than doubled their dividend payment, growing at a 15.2% compound annual growth rate. And you can see they've been raising the dividend every single year going back to 2011. The most recent dividend increase was 15.3%. The one prior to that was 15.5%. And yes, the stock has gone up from its recent low, but it's still definitely cheap. If we look over the past 5 years, this 1.3% yield, it's in the 94th percentile. The median yield in that time is 0.65%. So compared to how Intuit has historically traded, the stock is looking cheap. The dividend's super sustainable at a 19.5% free cash flow payout ratio. That's one of the lowest of the past 10 years for them. Based on an earnings payout ratio, it's 30.7%, very sustainable. If we look at the company's earnings per share over the trailing 12 months and we look at their PE ratio, this is in our tool called the PE Analyzer, similar to the yield analyzer we were just looking at. And you can see that it's currently in the 5th percentile, meaning that it's historically low PE ratio based on the past 5 years. every single day the P ratio over the past 5 years. This is well below the median, which is 59. This is trailing 12 months GAAP earnings per share. We can also look at the forward-looking earnings per share. This would be non-GAAP. The median multiple in that time is 31.72. We're currently at a forward-looking P of 13.5. So this is next year's earnings per share expectations. That's historically low and super cheap if the company continues to grow earnings 10 to 15% a year. In hindsight, that will look very cheap. Here's another way to look at it. We have the value graph tool. If we go back to that forward-looking earnings per share, and we look at the median multiple over the past 5 years, that 31.72, and we assume that to be the implied fair value of the stock whenever it's trading at that multiple. And right now, Intuit stock is trading 57% below the implied fair value. If it ever got back up to that 5-year median of 31.72, it would be 134% upside from today's price. And this isn't even accounting for the growth in the years to come. That's just a re-rating based on the multiple the stock is trading at. The actual business and earnings will continue growing over time. At least that's what analysts are expecting right now. And that's what recent history shows for Intuit stock. Even if the stock doesn't get re-rated upwards, current earnings estimates are expecting the stock to continue growing. The stock would have 69% upside by 2030, 14.4% annualized growth. And if the stock gets re-rated back up to its historical median, that'd be huge for the stock. So those were some of my thoughts on Intuit. I think it's still a pretty interesting value play. I will definitely be covering that after it reports earnings. I'll give it its own full detailed video with some more information. So subscribe if you want to see that. Other companies that report after close, Zoom and Box, those are also kind of software companies that are pretty beaten down. Zoom's interesting, it peaked during the pandemic, but now it actually trades at a pretty attractive valuation as well. Box also looks pretty cheap right now. If we go to Wednesday before market open, SJM, that's the Smucker's company, they report before market open. So does Kohl's, that's KSS, and WSM, which is Williams-Sonoma. These are all dividend growth companies. I take that back. I have not looked at Kohl's recently. They're down 70% over the past 5 years, and they cut the dividend by 50%. Actually, they had a 75% dividend cut from the peak. So Kohl's was historically a dividend growth stock. They suspended it during the pandemic. A lot of retail companies did that in different types of businesses. They brought it back. They raised it once, and then they had to cut it. Not a Kohl's guy, haven't been following this company, but it's down a lot. So maybe you could look at it as a value play if you do your research and it looks promising. If we go back to SJM, that's a company I've historically owned in the past. However, I since got rid of it as I focused more on total return and growth and dividend growth. I like a lot of the consumer packaged goods companies. I'm a big fan of when you go to the grocery store aisle, I know all the brands of what company owns what. I find it all very interesting. But there's not a lot of growth in some of these bigger old companies. And because of that, when there's not the growth, you have to buy them super cheap. I don't think it trades cheap enough. Over the past 5 years, their dividend's only up 13%. It's a 2.5% compound annual growth rate. The most recent dividend increase is 1.82%. And over the past 5 years, it's right in the middle fair value of its dividend yield, how it's traded, right in the 50th percentile, right on the median. So while I like a lot of the brands they own, if you don't know, they own Jif Peanut Butter, they own Uncrustables. Uncrustables is a awesome business. It's a cash cow. It's getting copycatted left and right. You got all those sports people investing in the jams thing. You got some Silicon Valley people investing in some high-tech version of it. I forget what that one's even called. That's not a bad thing though, because they have the most recognizable brand in that category, and it will continue being a big seller. WSM stock, this is a dividend growth company. It's done much better over the past 5 years than those two other examples. And their dividend growth has been higher, up 157% over the past 5 years. That's a 20.8% CAGR. Forward-looking dividend yields, 1.28%. Big dividend growth stock here. However, it is trading at a historically low dividend yield right now. So the stock price appreciation has been outpacing the dividend growth. But then the big story of this earnings week is Wednesday after market close. That's Nvidia, ticker symbol NVDA. Now, I dove into this a ton at the beginning of the video, but that's because it's the big story and it's also very interesting. I also happen to own a stake, full transparency, do your own research. Don't just blindly follow me. And it's one of the most impressive stories in the history of capitalism, the growth of the data center build out over the past 3 or so years. You can see the expectation is $92.2 billion in this quarter for revenue. and $2.09 of earnings per share. I would expect them to beat in both of those. And it's the growth of Nvidia, the actual growth of the fundamentals, which is the reason why the stock price has been up so much over the past 5 years. 838% price return. That's a 56% compound annual growth rate. But as I mentioned earlier, the stock price is only up 15% over the past year, despite the actual cash flow the company generating being up 65% year over year in that time. Earnings per share up 83% year over year. And this is all still ramping up. They just had $48.5 billion of free cash flow in the latest quarter. As I went over in my full NVIDIA video, Jensen just a few months ago, I forget what month it was, like May or something, they had a GTC conference and he was up there giving his speech and he said they had line of sight to $1 trillion of revenue over the next 2 years. And if you've been following basically all the guidance they give, they end up beating. So they're kind of conservative with the guidance they give out. Now, that wasn't specific financial quarter guidance, but he did say it on stage in front of everyone. Over the trailing 12 months, the company's generated $253 billion of revenue, $81 billion in the latest quarter. That's up 85% year over year. And that was the first quarter in the time of where he said they would do $1 trillion of revenue. So what does that mean? It means they're going to be getting to an average of $125 billion a quarter over those 8 quarters. Not going to get there this quarter, not going to get there next quarter. So that means they're going to be well above that on the back end. Right now, analysts are expecting $394 billion in fiscal year 2027 and $570 billion in fiscal year 2028. Add those up, you're a little below $1 trillion. So right now, I would say analyst estimates for revenue are a little low compared to what's likely going to happen. All of the demand signals are still super strong in the data center build out. You had basically all the hyperscalers raising CapEx. They're starting to see operating cash flow growth. Their stock prices finally went up. They were being punished for the CapEx increases. Now Amazon and Microsoft, they finally got a little bit of a pop from it. The cloud growth is really good. And on the actual demand side of AI usage and AI inference and token generation, it's all just exploding. I went over this a lot in my NVIDIA analysis, but I'm just doing some back of the napkin math here for you guys. So latest quarter, they did $81.6 billion. That was $48.5 billion of free cash flow. So if they're going to do $1 trillion of revenue over the next 2 years, that means they're going to have roughly $500 billion of free cash flow generated in that time. That will be the most amount of free cash flow ever generated over a 2-year span. That will give NVIDIA one of the best balance sheets in the history of corporations, funded by amazing cash flow. And NVIDIA is not a CapEx heavy company themselves. They get the chips manufactured by TSMC, super optimized for free cash flow generation. The fabless semiconductor model, it's a beautiful free cash flow business model. They have started building some data centers themselves, though, to train open models, which I think is a good thing because it just helps spur demand in general. But if we look at NVIDIA, over the trailing 12 months, they've spent $47 billion in share buybacks. I would expect their return to shareholders to go up massively as they continue to generate more and more cash. Again, my quote at the beginning, short term, the market's a voting machine. In the long run, it's a weighing machine. NVIDIA is becoming a heavy business, and their capacity to reward shareholders and their intrinsic value of the company is growing. And that's why they just raised their dividend payment, which they rarely do. They raised it by 2,400%. And now it actually has a reasonable yield of 0.48%. All of the signs for NVIDIA are that growth is set to continue at least for the next year or two. People will have tons of debate of what year 3, 4, 5, and even 10 years from now is going to look like on the demand side for NVIDIA. We don't have enough time to go into all that in this video. Right now, I would say the consensus in the market with how things are being valued is that NVIDIA, we're close to the peak and there's not going to be a lot of growth from here. That's why the stock price hasn't gone up much in the past year. It's also why it's trading at a very reasonable valuation. The PE over the trailing 12 months is 31.9. The PE forward-looking is 23.12. So if we look at the forward-looking PE ratio over the past 5 years, this is actually historically low for NVIDIA. The median is 38.27. So we're in the 15th percentile right now. And let's just say we base it on the trailing 12 months P ratio. The current is 35.7 for adjusted earnings per share. The median over the past 5 years is 53.7. So if we assume that as being the fair value for NVIDIA stock, the median multiple, NVIDIA is currently trading 34% below that median. If we do it based on forward-looking earnings per share, so next year's earnings, the median has been 38.27 over the past 5 years for NVIDIA. This implies an even larger discount for NVIDIA stock. And if the company got re-rated back up to that 38 multiple, that'd be 65% upside from here. But the thing you have to remember is that Nvidia is growing very fast still. It's just unclear how much longer it can continue growing. And frankly, I was wrong about this initially. I didn't think Nvidia could even get to where it is here. I was not aware of how big the market could be. And I think that still might be the fact that people are being early in calling an AI bubble. We still have many, many years of growth ahead there. I'm not saying there can't be an overbuild in like 2030 or at some point in the future, but it's not the current conditions on the ground. And I think people struggle to think in exponentials. We're talking about very high growth rates right here for Nvidia. The current analyst expectation is 92% growth year over year in fiscal 2027. And then they're expecting that to go down to 42 and then 20. But really the 3, 4, and 5 year completely changes all the time. People have no idea what to think in those later years. And given the multiple Nvidia's trading at, which is cheaper than like Coca-Cola and Procter & Gamble on a forward-looking basis, when its actual fundamentals are growing 80% and the stock price is only up 15% over the past year, I don't think the market is pricing in the scenario where Nvidia grows 80% year over year again, and then it does that the next year and potentially does that the next year. If that happens, or even if it goes 80%, 60%, 50%, that's a ton of growth. And Nvidia would look very cheap today based on that. And then the question is the company done growing after that? I'll let you decide that one. So this is definitely the most interesting earnings report to cover during the week. It will definitely impact a lot of the broader market in the coming months because it has to do with the entire tech and AI trade, which is a large part of the overall market. So I look forward to reading through the earnings report and listening to the earnings call. And I'll be back with a video to analyze that. So if you want my thoughts post earnings, subscribe to the channel and I'll be giving you an update on that. But guys, we're not done. There are more companies reporting earnings. As an example, Salesforce, ticker symbol CRM, that's also Wednesday after market close. CrowdStrike, ticker symbol CRD, that's another company reporting. That's a cybersecurity company. I'm going to dive in a little bit more on Salesforce here. This is the largest pure enterprise software company. It's like the mental meme of what a software as a service enterprise stock is. And of course, it's sold off along with the broader SaaSpocalypse narrative, although it has rebounded along with the others in recent weeks. And that's because it's looking dirt cheap. This has been a compounder in the market. Reliable subscription revenue growing 10%, 15% year over year. 5-year CAGR revenue is 12.7%. And the company has started generating a ton of free cash flow. $14.6 billion over the trailing 12 months, up 15% year over year. And while the stock has traded off a ton, its free cash flow is at all-time highs. The company has recently started paying a dividend, but still a small payout. It's a 0.84% dividend yield. I'll be doing a full Salesforce video. That'll be after the earnings report. Right now, I'm just going to give you a little preview. And my insight right now is that I think the stock is still cheap. Over the past 5 years, the median multiple that Salesforce has traded at, this is earnings per share, trailing 12 months, adjusted earnings per share. The median multiple is 33.43. It's currently 15.09. That means if the stock jumps back up to that, it would be an implied fair value of $463, which would be 121% upside from here. And by the way, if we go over the 10-year period, it's traded at an even higher multiple. But to be fair, in this 2016 to 2021 period, the company was growing faster on the top line. And also valuations were a little more irrational then. We were in the ZERP era. But from 2022 on, the valuations have been pretty reasonable on Salesforce stock. So it's trading well below that 5-year period. And this is true based on free cash flow too. Based on free cash flow, Salesforce is looking super cheap. Other companies, Thursday before market open, we have Hormel, ticker symbol HRL. This is a dividend stock many people own. I'll likely not be covering it later this week, but it has a long history of dividend increases. Dividend growth has slowed down though. I think they were growing it far too aggressive for a number of years. It wasn't backed up by the fundamentals. The past 5 years, it's grown at 3.6% compound annual growth rate. The stock price is low, so it does look like it's trading at historically high yield in the 90th percentile, 4.86%. So it does look historically high. But the problem is that the payout ratio is getting in a not good range for Hormel stock. 118% free cash flow payout ratio in the recent year, 132% based on earnings payout ratio. And over the past decade, free cash flow hasn't grown at all at Hormel. And it's in a downtrend currently. but starting to uptick in the latest quarter. Operating cash flow completely flat over the past 10 years. So in my opinion, if your goal is total return, I don't think Hormel is very attractive at the current price. If the company's cash flows and dividends aren't going to be growing at a high rate, you need to buy it super cheap for it to be a good investment. And then finally, on Thursday after market close, there's two companies I'm going to mention here. Well, there's a few that I could throw out. I'll throw out Autodesk, I'll throw out Ulta, I'll throw out Gap, Affirm. Those are all reporting. But the ones I wanted to talk about were MRVL and Workday. Now, first with MRVL Technology. This is a semiconductor company. And the reason why it's interesting is earlier this year, when Jensen was in Taiwan at some Nvidia event, and he was trying to tell everyone how great they needed to invest in the semiconductor supply chain, basically to help grow it so that they can support Nvidia. He threw out MRVL Technology as a company that he thought could be one of the next $1 trillion semiconductor stocks. Current market cap, $200 billion. Now, I'm going to be honest, I haven't done my research on their company. I don't know the entire ins and out of their business. So I'm not going to tell you that. You should do your own research before making any investing decisions. I don't own the stock. Haven't even looked into it that much, to be honest. But the reason why I found it to be interesting is that they actually haven't been growing that much recently. They've started to in the past few quarters. Actually, their earnings per share growth is pretty good. 29% compound annual growth rate over the past 10 years. And their earnings per share is up 100% over the past 3 years. But right now, the stock price is leading ahead of that actual improvement in the fundamentals. I'm pretty sure it had a pop after Jensen said that, and it seems like it came off a little bit. But the question is whether the fundamentals continue growing at this company. It will be interesting to follow. You should probably listen to the earnings call if you're interested. You should probably read the report. Also, you should look at how their products fit into the broader AI data center build out, how much spend they're going to get allocated, how core they are, how replaceable they are. Those are all kind of things you should be looking at. I haven't done the research enough to really have a full section here for you on this stock. And then to wrap it up, I'm going to talk about Workday, ticker symbol WDAY. This is another software company that has been a victim of the SaaS apocalypse. They sold off 62% from their high, and they have rebounded in recent weeks. Part of that was that there is rumors of an acquisition from Silver Lake, a take private, similar to how they were involved in taking Electronic Arts, EA, private. So there's some private equity interest in some of these beaten down software stocks. And the reason is what we've been talking about earlier. They're solid businesses. Their fundamentals haven't declined. It's still growing. Reliable subscription revenue. Generates real free cash flow. Free cash flow is up 28% year over year. $2.97 billion over the trailing 12 months. And some people are starting to look at these beaten down software stocks as value plays and opportunities. They used to trade at premium multiples. Over the past 5 years, the median multiple for Workday stock is 41.2. That's adjusted earnings per share for the trailing 12 months past 5 years. Its current multiple is 20.62. If the company returned to that median multiple, that would be 100% upside from here. But you also have to keep in mind that the fair value is growing because the business is growing. Their earnings are growing. So at a certain point, a re-rating upwards, think of it as it could be part of your margin of safety when you're investing. You don't want to be purely reliant on what the market thinks about your stock, how they choose to value it. But it can be a powerful margin of safety if you already believe that the actual earnings and fundamentals of the business are going to continue improving. So that's my thoughts on the stocks reporting earnings this week. If you want to use the same exact stock research tools that I use, like this value graph as an example, it's all available at dividenddata.com. Right now, we have a sale for founding members because we just launched the next generation version of the product. It's been out for a month and the feedback has been awesome. People are really loving it. It's really a massive improvement. And to celebrate that, we're doing a sale where you can get 50% off annual membership to the tool. And the reason why we do that is we want to incentivize people to be long-term investors in our product. After all, we're a community of long-term investors. So if you want to try it out, there's a 30-day money-back guarantee, so there's no risk. The link is in the description and pinned comment of the video. You can scan that QR code in the bottom right corner. And I basically built the tool to give me everything I want when analyzing an investment. It also has great features for tracking your portfolio and watch list and keeping up with key events like earnings season. So if the tool helps you find just one better stock or avoid a potential mistake, it way more than pays for itself many times over. And if you find the content I put out here to be valuable, that's the best way to support the channel. Become a member at dividenddata.com, join the community. And if you want to see my upcoming videos, make sure to leave a like, comment, and subscribe to the channel. Thank you for watching, and I'll see you in the next one.